It looks like stock splits are becoming more popular once more. We're seeing Apple and also Tesla perform stock splits this month. So with that said, I want to go through those stock splits and also some others that I think maybe could possibly happen in the future, or maybe a few stocks that would do well to actually split their stocks, because we've seen a lot of tech stocks specifically this year just really climb really high in valuations, and their stocks really have seen meteoric rises, really 100%, or if you take a longer time, maybe even multiples of the original share price that it came at in the IPO. So I want to go through those potential companies that would do well for a stock split. But let's start with Apple. So as we know, Apple is performing a 4-to-1 stock split, and this is happening this month. So the current price, the share price of Apple is about $460 right now. So obviously divide that by 4 and you get about $115. So it's exactly the same in terms of the value that you have in the company. So if you own one share now at 460, you're going to have actually four shares. So you'll get 3 new shares, keep the original share that you have. So you just have the same investment, more shares, and obviously a lower price. Now, in terms of actual stock splits, it doesn't affect the value of a company, or at least it shouldn't. So as we've seen, Apple and also Tesla, which I will get onto in a second, when they announced the stock splits, the share prices reacted really well. You saw some buying in the stocks because of the stock split, and really a lot of the traders and I guess market analysts online and on TV and in the media were kind of questioning this and were just scratching their heads like, why on earth are people buying on the back of a stock split? And well, they are totally correct. I mean, there's no value created from a stock split. It literally is just cutting up a pie into more pieces. You don't have another pie, you don't have more pie. It's just absolutely irrelevant to the value of a company. So why exactly did the share prices rise off the back of these announcements? We'll get into that really because, well, it's just a psychological thing to say that they are going after more retail investors. They're making the shares actually just more available for us to buy and sell. So that is actually a positive thing, and overall it may just increase liquidity in the stocks. So Apple 4-to-1. So taking it from about 400 or maybe even $500 odd by the time they split, and making it just more accessible at around about $100. So people feel like they can actually trade in. Also with Apple as well, which doesn't apply to all of these other companies, is that Apple are part of the Dow Jones, and the Dow Jones Industrial Index is an index of it's kind of a weird index. It's price weighted, and that means that the more expensive your shares are, then they take up a bigger weighting in the index. And this is really kind of an old way of doing it. It's a really old index, and it just kind of is a bit old now, and that's just how they do it, and they will never change. And that is why Apple has actually changed and split their stock more than once over the years. They just cannot be such a massive weighting in that index. Otherwise, the index is essentially just an Apple share tracker. And so they split the stock, get the value of each share down, and so the Dow Jones has a little bit more to work with. But this can also be said for the S&P 500 now. We can see tech stocks. I mean, the S&P 500 was basically called the S&P 5 the other day, which is the FANGs basically, just taking up so much of that index. When you invest in 500 shares, it is heavily weighted and geared towards those tech stocks, which really do pull it and push it around. Then we get Tesla coming out a few days after saying they're going to split their stock by 5-to-1. And yeah, I think 5-to-1 is okay. Could they have maybe gone a bit further and split it 10-to-1? So the current share price for Tesla is $1,600. And that is just very expensive for one share. Like I said, the value of the company itself doesn't change because they're splitting the shares. But of course, a lot of retail investors are in Tesla, and a lot of people want to trade Tesla. Tesla stock moved massively on the move of this stock split as well, which again, everyone was head scratching about. There's no extra added value to the company, but retail investors loved this from Tesla, and Elon definitely just giving the nod to retail investors that, hey, we're thinking about you, and if you want to trade our shares, it's easier. How about some shares that haven't split, but in my opinion have had massive runs, especially recently with the health situation? We've got a lot of e-commerce and tech stocks that have really benefited from that. So off the top of my head, we've got PayPal, a lot of other ones, but I've chosen Shopify here, and Shopify has really benefited from this health situation. So this is an e-commerce stock. Shopify helps small and medium-sized businesses and enterprises essentially just move to digital, not just setting up an online store, but it also helps them in their physical stores in terms of payments. You can manage stock, and there's lots of data that you can just feed everything through Shopify. Shopify is a great service, and I think it helps a lot of businesses, and it has done fantastically. Problem is, Shopify now is $1,000 a share, which is expensive. Again, if you're just wanting to buy a small amount for your portfolio, having to spend $1,000 just for one share. A 5-to-1 split would take that down to 200, and obviously 10-to-1 down to $100. The IPO for Shopify was in May 2015, 5 years ago, and it came onto the market at $28. So a very good run for that stock. But $1,000 for one share, it just means that retail investors aren't going to be flocking to that. Do Shopify want to attract retail investors to trade the stock? Maybe they don't. Maybe they just don't care. Maybe they don't care about liquidity, and they don't need to raise any money, so that's just not something they're thinking about, and that's absolutely fine. But Shopify has had a good run, and just taking the share price down, issuing more shares, having a lower share price means that people can trade it and trim their positions and trade it in and out a little bit more easily. Then next on the list, I have Chipotle, which is another stock that has done absolutely fantastically during the health situation for various reasons. Some restaurants are really not doing well, but Chipotle has really gone from strength to strength. Currently trading over $1,000, $1,186 more or less. So it's up at that $1,000 range. So a 5-to-1 would be so if they did a 5-to-1 stock split, it would be about $237. A 10-to-1 stock split, obviously $118. And that would just make it seem more accessible for retail traders to actually get in and trade this thing. And do companies need this? Absolutely not. I mean, why do they care who buys and sells the stock, really? But the thing is, if there's volume in the stock, then it means that the business can possibly just better reflect what investors actually are thinking about the stock. So yeah, there are some benefits to that. But actually, Chipotle, when it came onto the market, it came on at $22. And it's now valued at over $1,000. It actually jumped to $42 on the first day of trading. So if you'd put in $10,000 at the IPO price of $22, that would be worth $490,000 now. So both Shopify and Chipotle have had amazing runs since their IPOs. You've seen that both share prices up around $1,000. So maybe they could benefit from just splitting the shares and making it easier for retail investors to trade them if they wanted to. Maybe they don't, and they're just happy with the big guys and the institutions in there that really don't care about the share price. Also on the list, and I have to mention this one, is Amazon. And yeah, maybe there's less retail interest in this. Some stocks have a high amount of retail interest in terms of you and me trying to buy them for ourselves and just trade in and out. And some stocks don't. $3,000 for one share of Amazon stock. And as I said, the share price doesn't matter, but it just is psychological. When people look at Amazon, it's a big company. It seems to be sort of taking control of all of our lives in terms of everything it does, and a very highly priced stock as well. Just makes it seem sort of more powerful. And if they split the stock, it would look a bit more accessible to us. Also, when it does come to stock splits, we had Apple do it and then Tesla do it within very short space of time, and they're going to actually be splitting the stock this month at the same time. Then with other companies, if they start splitting stocks, do they risk maybe being seen as a copycat? And maybe so, maybe not. It actually, again, to the market, to brokers and investors, who really just don't care. It just is irrelevant, the actual price of each share. As I said, it's the fundamental value of the company that is important. But with so many tech stocks, especially Apple, Microsoft, Amazon having great runs, Shopify and Chipotle, as I said, and many more, just having huge share prices now, it's a psychological thing where it just seems too expensive. But anyway, I'd like to know your thoughts. Which stocks would you like to see a stock split happen to so they become a little bit more accessible? Or do you just not care about this because you have a Robinhood trading account and you can trade fractional shares anyway, which is kind of more or less the same thing? You can actually just have a smaller investment. Let me know in the comments. I'd love to know your thoughts. That's it for this one though, and I'll see you in the next one.